Well, good day there, WealthPress subscribers, viewers, traders, and investors. It's time for another end-of-week wrap-up, and I'm here as usual with Mr. Roger Scott. Roger, welcome. How are you today?
I'm doing great, James. Thank you for having me on.
Oh, of course, it's a pleasure. Roger, big news of the day is hospitalizations are starting to skyrocket to the point where the entire healthcare system is somewhat threatened. The market doesn't seem to care as everything is on liftoff mode today, just surging higher. What are the implications of a crumbling healthcare system in the midst of the pandemic for traders?
Under the hood, I am seeing a big mess. Let me talk. I want to talk to you about this. This is not pretty. Number one, put to call ratio is back below 70. That's telling us that investors and traders are getting extremely exuberant and way too greedy. And whenever that happens, the market turns. It's like a rubber band. And usually the put to call ratio is random and it doesn't really represent too much. But when it pulls sharp, it means something. And we're right now at that threshold level, close to that threshold level. That's number one. Number two, momentum levels on the Nasdaq and the S&P on the 200-day are the highest they've been in 11 years. We have over 90% of stocks in the S&P 500 trading above the 200-day moving average right now. And the Nasdaq 100 is not far behind. That's number two. Number three, we're having a long-term divergence between price action and the RSI oscillator on the Nasdaq and the S&P 500. Both. One is going like this higher, price is going higher. The highs on the RSI are going like this. Not over a 2-day basis, not over a 2-week basis, since September 2nd. Since September 2nd. Stocks like Apple and Nvidia have not been able to break their high since September 2nd. And here's the biggest kicker. The top 5 ETFs I'm looking at right now are all, I use relative strength for my analysis. They're all stay-at-home ETFs that were making new highs back in February and March. I'm actually going to give you the ticker symbol to some of them, okay?
Okay, that sounds like a plan.
First one, CHIQ. Second one, SOCL. Next one, PAWZ, PAWZ. Next one is ARKF. And the next one is actually really interesting, EMQQ. And this is why it's interesting. It's an emerging market tech ETF.
Okay, so just give us that list again, Roger, please.
Of course. CHIQ, SOCL, PAWZ, ARKF, and EMQQ. And what I was saying was the last one is very interesting because I'll tell you something else. And this is another factor that's pointing in the direction of that's reassuring or giving me assurance about what I'm saying. The emerging markets, James, are even outperforming the Russell. As you know, since the first debate, the small caps have been outperforming the larger stocks. And that has not changed. But now finally something happened. The global markets, emerging markets, James, for the first time in, I think, a year and a half or 2 years, is outperforming U.S. indices. That's first of all, that's a big sign because Democratic presidents tend to be more global centric than Republican presidents. You know, with Trump, it was all about America, which is fine. I don't want to get political here. But with Biden, it's going to be a lot more global, global economy and emerging markets. If you look at the emerging market ETF, and I have 2 of them, one is ticker EEM, and the other one is VWO. They both track emerging markets. On a relative strength basis, James, they have been outperforming even the U.S. small caps.
Those are ETFs.
These are ETFs. Everything I've given you is ETFs. And if you look at the constituents of these ETFs, you're going to see almost every stock that I was recommending in February, March, and April of this year.
Wow.
So I kind of put together a little package here for you with a ribbon.
Great. So the the ETF managers are watching our show.
Yeah. Yeah. I think so. Well, I always recommend during these critical turning points, what I always tell traders is to get out of the stocks, put 50% in cash, and put the rest 50% in the ETFs that were similar to the stocks that were going up. That way, if they miss the boat a little bit, they can take profit, and B, ETFs don't go down as fast as the individual stocks because they have so many of them. So an ETF is a good way to transition from between stocks and cash. That's kind of what I do. And I believe these ETFs right now. So if you're still bullish on the stock market, you don't necessarily have to, get out or gamble on individual stocks. Take your profit. I mean, there's plenty of profit on the table. Nasdaq and S&P are not at all-time highs right now. Take your profit, put 50% of it in these ETFs and the rest in cash. And then if we're wrong, you're still going to get some of the upside from the ETFs. And if we're right, then boom, you got a good little protection. 50% is already in cash, and 50% has a nice broad exposure.
Sure. How about the options trade in this market?
I would be very cautious with options right now. I would be very cautious because implied volatility is very, very high because the market's at all-time highs right now. So if you have a very specific plan, options may be good, but otherwise I would be very cautious with options because of the volatility, and we don't necessarily know how long we may be at these levels. As I said, divergence has been going on since September 2nd, and the red lights really started going off, James, the last 3 days. As you remember, Monday, I was still very perplexed. I told you, I'm very confused. I just don't know what to do right now. I don't know if we're going to go left or right. Yeah. And now I feel a lot more confident about going back to where we were beginning of this year versus looking forward.
Sure. We're seeing a real explosion in the price of gold, and especially in terms of the volume in the gold spot market. Is that an indication that there's nervousness on the sort of the outer edges of the large capital pool community?
Yes, absolutely. Absolutely. And remember, and this is also in line with what Jeff and I were talking about last week. I don't remember if you were on the call or not, but we were talking about I think you were. We were talking about how usually when gold does certain things, the gold stocks tend to mimic gold very, very highly. And we're actually not seeing it, and we're actually seeing some miners a lot stronger. And I'm kind of interested in, and I brought this up in one of my videos. I kind of like the fact that the gold is hitting the 200-day line and is showing oversold levels at the exact same time, James, that the stock market is showing us the opposite to the upside.
Well, and that's something that happens usually when things are about to change rather dramatically in the main markets.
Exactly. So, and that's exactly what I'm saying. And I have not given up on gold. I usually give up on assets trading below the 200-day moving average. I'm not so quick to give up on gold for all of the reasons we've just discussed.
Okay. So then should we be then dividing our available capital? You said 50% cash, 50% ETFs. Should there be an allocation for something more defensive like precious metals and or bonds?
Well, when I say cash, I usually just mean getting out of it's more of a way to just get out of stocks, the U.S. stock market. So yeah, in my opinion, what I like to do is what I would do right now is this. And again, folks, this is just an opinion. This is not something I'm telling you to do. This is just what I would do. I would put 50% of I would take 50% of my assets. I would put 15 to 20% in bonds, long-term bonds. I would put 15 to 20% in gold. And believe it or not, I would actually put, and it's, I think, the first time I'm ever saying this. This is a first for me. I would put it in Bitcoin.
Bitcoin, wow.
Yeah. I think Bitcoin is now, because we've seen such poor performance from the US dollar. I don't think gold is going to be used as a alternate for the US dollar as much as Bitcoin and alternate currencies, because they have very little directional bias in terms of the US dollar and correlation. So I am seeing some investors, more and more investors, start to get into Bitcoin. Now, I'm not a big Bitcoin guy yet. I'm not. So for me to do something like that is pretty it's not something I would say or do on a regular basis. And then I would put the rest of my equities into these ETFs, maybe a little more in the emerging markets, and I've given you tickers for those as well.
Sure. So fundamentally, Bitcoin's sole catalyst rests strictly on speculative behaviors. Is that correct?
Yes. Yes.
So are you suggesting then that the speculation of a higher Bitcoin is going to be attractive to people who are getting nervous about the purchasing power of the US dollar?
That's exactly what I'm saying. And the potential nervousness on the US stock market. And also, look, a lot of people don't feel comfortable with Biden taking office. I'll say it. I mean, I'm going to be honest with you. A lot of people are going to lose, a lot of our readers, not a lot, some of our readers are going to lose some confidence in the US economy because of the president that's going to be. I think that's a fair statement. I'm not going to be one of those people, but I do. We have some very political people. So I think that's also going to be a major factor for Bitcoin.
Right. For me, markets are agnostic when it comes to presidents, except for at the moment of their, arrival and departure during the transition phases. But mostly markets don't care. Roger, I'm really curious about this phenomenon today we saw where the price of oil has surged back up above $46 a barrel, despite the fact that Saudi Arabia and other OPEC members have announced an incremental increase in supply. To me, that's counterintuitive. Oil should be falling the other way, unless the expectation for a revived US economy trumps, and I say that with some pun intended, trumps the expectation of oversupply of oil.
I think it may be the fact that they're finally willing to sit at the table together, James. I honestly, in my opinion, I think you may be overshooting it. I think it's the first time OPEC and Russia and all of them decided the willingness to sit at a table, and the agreement is I read the doc, and while let's just say that people are willing to cross their fingers and where they weren't even willing to do that 6 months ago. I think the fact that they're coming to the table is what's the promise that something may happen in the future. Remember, the markets are always looking ahead. So I don't think it's a global economy. I think global economy right now is really and remember, America is the leader in global economy, and Biden is going to be very, very big on non-traditional energy. I mean, we know that. I mean, that's his biggest thing. So I don't think it's that. I think it's honestly the fact that they're willing to sit down together at a table, and the fact that they are promising more adaptations to the economy over the next quarter. I think that's where it is. I think it's just hope that the hope will get better.
Okay, Roger, that's great. Let's leave it there for now. That's a great update as per usual, and I look forward to seeing you on Monday. Have a fantastic weekend.
You do the same, James. Stay warm. I'll talk to you later. Have a great weekend.
Thanks. Bye.